Thomas. Good to see you. Today we have a really important conversation. Protecting your money in a bear market based on your age. The S&P 500's recent decline into bear market territory has taken a chunk out of everybody's retirement accounts. So I think a lot of people are asking, should we sell? Should we buy the dip? But of course, the advice is going to be different depending on your age. But in the past, buying the dip during periods of low interest has paid off. So is that your advice to young investors?
Absolutely. I'm a long-term strategist. I like this, clients that are relatively young. I say, let's look at your portfolio over the long term. Any event that, the market is, at decreasing, that's actually an opportunity for you to buy in if you have a long-term investment strategy. I like to talk about dollar cost averaging, meaning that when the market is high, you're putting money in. When the market is low, you're putting money in, but over time it averages out. So if you have a pretty extensive time horizon, this is a great opportunity for you to buy things at discount. If you're a little bit older and don't have that long of a time horizon, then we need to have a conversation about some different options that may be available for you in regards to maximizing your retirement.
Right. And I'm glad you brought that up because I do want to touch on it. I can't imagine how stressful it would be if you are in retirement or near retirement right now in a bear market. Here's a look at the 10 worst bear markets. 2020 isn't on here, but this is so stressful because this is when we are in our decumulation phase, right, Thomas?
For sure. And that's probably one of, the accumulation phase. I sometimes say that that's the easy part.
Right.
When you're distributing those funds, that's the hard part. A lot of advisors may not talk about the sequence of returns, but if you're taking money out when the actual market is going down, it can decimate your portfolio. It would accelerate the decumulation of the actual portfolio. So it's important, to think about some other options, potentially when the market is going down. That's something that you don't want to do. Just if you were to compare, two portfolios, one person is retiring when the market is good versus one retiring when the market is not so good, and they're pulling money out at the same rate. The one that's pulling money out when the market is good is going to have a longevity of assets versus the one that's pulling out when the market is not so good.
So speaking of the market not being so good, still gives me a little anxiety to look at it. This is the S&P right now, Thomas. So during periods like this, is this when retirees should be considering guaranteed income streams like annuities?
Absolutely. I mean, there's a couple of different schools of thought that you can exercise when you're thinking about markets are in their downturn phase. Listen, we've been on this bull run. We were on a bull run for 12 years, and then the market is corrected, right? So as we preached before, take some of those, some of that profit off the table. You can actually leverage an annuity. A lot of them are now paying bonuses, 10, 15, maybe even 30% I've seen. That are out there that you can recoup some of those losses to make up for what you've lost in the market here, and then also have longevity in your assets that you never run out of money. So I would highly recommend having that conversation and having this a part of your tax plan.
Right. So as retirees try to determine whether to tap their 401k or their Social Security benefits, is this another time where they should be considering a Social Security bridge?
Yeah, I mean, definitely, it's all about, when you think about Social Security, 62 is when you can start pulling that money out. It grows at a rate of 8% for the next, 8 years to age 70. So you need to think about really how that money can impact your overall longevity of assets, because it's probably one of your largest assets when you think about it, which can cost you hundreds of thousands of dollars if you're not strategizing right. If it makes sense, for you to pull it out, maybe you have a health condition or something like that, and you need the money now, the bridge, then absolutely, then you may want to consider it. But it's important that you run an analysis and work with a financial planner to do that.
Yeah, that is very complicated in and of itself. Thomas, if somebody has questions about this, what's the best way to reach you?
They can definitely go to my website at martinheritagegroup.llc.com. They can shoot me an email at info@martinheritagegroup.llc.com, and they can also give me a phone call, 651-503-6064, or they can reach me on all social media outlets at Martin Heritage Group LLC.
All right, Thomas, thank you.
Thank you, Erin.